So in Chapter 13, the focus is on current liabilities and contingencies. And so we're sort of shifting from Intermediate 1, where we're moving to the other parts of the balance sheet where we focus on liabilities and equity here in Intermediate 2. So what I plan to do with these little videos is just to walk through a few of the more difficult transactions. And so it's, expected that the students are able to kind of read through the PowerPoint, use their textbook, use the Learn Smart and SmartBook modules in Connect to sort of guide you through the chapter materials. But then I'm going to work through a few extra problems in Excel. The Excel templates that I'm working on are already in Moodle. So there's an incomplete and a complete set of Excel spreadsheets. And so again, what I'm going to do is just highlight a few of the more difficult transactions that are discussed in each chapter and kind of create these video lectures so that you can kind of watch as I walk through those more difficult transactions. So in Chapter 13, again, it walks through a wide range of different current liability transactions. So things related to salaries, related to unearned revenue, a variety of different types of short-term liabilities. But what I'm going to focus on, two in particular, so if I scroll to slide 10, slide 11, what I'm going to do is walk through the example of a short-term note payable that has accrued interest that carries over from one period to the next. So this is an example of a liability where the interest needs to be accrued at the end of the first accounting period, even though it's not paid until the following accounting period. So that's kind of the example that I'm going to walk through here on slide 11. And then I'm also going to walk through slide 18, where it discusses a type of unearned revenue that's related to refundable deposits. So those will be the two that I walk through. And sometimes there will be two, sometimes there will be more than two. It just kind of depends on the content of the chapter. But a lot of what's discussed in this class was also discussed in financial accounting, again, as it relates to unearned revenue, as it relates to short-term notes, as it relates to those kinds of current liabilities. So again, I'll plan to walk through those two. So we'll start here with the short-term note payable. So the transaction that we're going to walk through is that on November 1st, our organization, so we are Affiliated Technologies, and we're going to take out a short-term loan, $700,000. It is a 6-month short-term loan that comes with a 12% interest rate. And so what we have to account for is the fact that on November 1st, we took out this loan. We're going to make a journal entry on November 1st. On December 31st, we have to account for the fact that it is now the end of the year, and we have to make an adjusting entry to accrue the amount of interest that we have incurred so far. And so we'll make a journal entry on December 31st, and then at the end of the actual note term, which would be 4 months later than December 31st, so we would be getting into the end of April, we would have to make a final journal entry that shows the amount of the total amount that we're paying off plus interest. So that's the kind of series of entries that we're going to make. So if I go over to my Excel spreadsheet, so I'm on the short-term note tab, and again, you'll see that there's a short-term note, a very simple example that's discussed in the lecture. Here is the sort of outline of that. And then there's a non-interest bearing note example again, and on the right-hand side, here is the example of that. But what we're going to focus on is here in the middle, this short-term note that has a year-end adjustment. So all of the information is presented in the Excel spreadsheet, and so what I now need to do is go into making my journal entry. So on November 1st, again, we have obtained a short-term loan. So what we have received in this transaction is going to be cash. So I'm going to debit cash for the full $700,000 amount of the loan, and then I'm going to credit short-term note payable. So I'm abbreviating short-term note payable, again, for the $700,000. So that would be the entry that we would make on the initial day that we take out this loan. Then on December 31st, what we would have to do is account for the amount of interest that we have incurred so far. And so the entry, first of all, that we would need to make is a very simple one that anytime we incur interest, we would have to debit interest expense. And in this case, because on December 31st, we're not actually paying off the amount of interest that we owe. This is an accrual, so we would have to credit interest payable or accrued interest or something along those lines. Again, not I'm not picky in terms of the names that we use, as long as we understand that this is a liability account that's related to interest. Now, the amount. So what we have to determine is how much interest have we incurred over the 2-month period. So you see up at the top, if I tap on my 12% interest rate, we have to understand that anytime we are given an interest rate in any of these problems, the interest rate that we are provided is an annual interest rate. And so what we need to do with these short-term notes is break that 12-month interest rate down into the number of months that we have actually had this loan outstanding for. So in this case, it would be 2 months. So you see I already have the calculation in here, but I'm going to delete that because I want to go through it step by step. So if we take a look at the total amount that we would incur over a 12-month period, again, that would be 12%. So what we want to do is take that 12%, and if we divide that 12% by 12, and again, if I change this in my formatting to a percentage, what that gives me is a monthly interest rate. And then I can take that monthly interest rate and I can multiply it by the amount of months that I've had outstanding. So for this problem, if I want to calculate 2 months worth of interest, what I will do is say equals 700,000, that's my outstanding loan amount, times the 1% monthly interest rate. So that's the number of months that, or I'm sorry, that's the annual interest rate divided by 12. And then I'm going to multiply that by the number of months that I have had this loan outstanding as of December 31st. So if I've had the loan outstanding for November and December, that gives me 2 months worth of interest. If I do that calculation, it gives me the amount of interest that I need to accrue for that 2-month period. So that's going to be what I include in this journal entry here. $14,000 is the total amount of interest expense and interest payable that I need to accrue for as of December 31st of the current period. So now the final step to this is when the actual loan comes due and we have to pay it off plus interest. We have to make a journal entry at that point in time. So because this was a 6-month loan and it was initiated on November 1st, that period would be April 30th. At the end of April, we would have to make an entry that's going to account for the amount of interest that we still owe, the total amount of the loan payment. We have to remove the liability from our accounting records. All of that is going to happen here on April 30th. So we'll start with the simplest part, which is that we want to debit the short-term note payable because on this day we are actually paying off the amount that we have due, right? So the $700,000 short-term note payable, we want to debit that. We essentially want to make that zero on our accounting records. The other liability that we are going to debit is going to be interest payable because on December 31st, we accounted for $14,000 worth of interest that was due as of December 31st. Now what we're saying here on April 30th is that that's no longer going to be a payable, that's no longer going to be a liability because we're going to pay for it today. So we're going to account for the removal or the decrease of that $14,000 interest payable. Lastly, in our debits is going to be interest expense. So interest expense, we have to account for the remaining period of time that we have had this loan outstanding. How much interest have we accrued? So we already on December 31st accounted for 2 months worth of interest. So now on April 30th, we need to account for the additional 4 months of interest expense because we've had a 6-month short-term note in this instance. So the way that I'm going to do that is again by taking equals the $700,000 loan times the monthly interest rate of 1%, and remember that we got that by taking the annual 12% interest rate and dividing it by 12. So my monthly interest rate of 1%, and then I'm going to multiply that by how many additional months of interest do we need to account for as of April 30th. If we already accounted for 2 months, we only have 4 months left, so times 4. If I take that, it gives me a total interest expense of $28,000 on April 30th. And then the last thing I need to account for is the cash. So the amount of cash that I'm going to have to pay out is going to be the initial loan plus the 2 months of interest that I accrued for in the first accounting period, plus the 4 months of interest expense that I'm accruing for in this accounting period. So the total amount that I'm going to have to pay out is $742,000. So again, that's a little bit more complicated version of a short-term note payable. Again, there's a very simple example here on the left-hand side that's kind of walked through in the lecture, and now we've gone through a little bit more of a complicated example where we have interest that's being accrued over 2 different accounting periods, and we have to make that adjustment as of year end. Okay. So then again, for Chapter 13, the only other example that I am walking through in these lectures is going to appear on slide 18. So again, as I mentioned at the beginning, there are going to be a variety of different examples that are worked through in this lecture. All of those different examples have a corresponding Excel spreadsheet where the solution is actually presented. And so what I'm doing is just picking out a couple of the more difficult ones, and I'm going to walk through those ones in these videos. So when it comes to, again, another type of current liability, one general category of current liabilities is unearned revenue. And so we can have unearned revenue in a variety of different instances. We can have just plain old unearned revenue where a customer has given us cash and we have not earned it yet. So, think of a landscaping company, or think of magazine subscriptions where the customer pays for 12 months of magazines, or maybe the customer pays for 2 months of landscaping services in advance of actually getting the services done. We, as the landscaping company or the magazine company, would have to report that cash as unearned revenue. We have gift cards. So if you think of a restaurant or a retail store that they hand out gift cards, they haven't actually delivered product or services to customers yet. They have received cash in advance of actually earning it. So again, another example of unearned revenue. This example that we're going to go through is related to refundable deposits. So a lot of times there may be instances where an organization has to deliver product essentially in certain containers, and over time they allow the customers to return those containers and get their money back. Another example of a refundable deposit is simply like an apartment deposit, right? So you put down a security deposit when you begin renting an apartment or a condo, and then after the lease agreement or the rental agreement is up, if there hasn't been any sort of damages done to that property, then the renter would receive that refundable deposit back. They would get their security deposit back. We're talking about the same kind of thing here, except instead of talking about a service like providing that space to a renter, we're talking about an actual product. So the example that we'll walk through here is related to a chemical company. So we are Rancor Chemical, and we sell combustible chemicals in very expensive reusable containers. So here's the thing. We have to deliver these chemicals to our customers in a safe way. So we use these expensive containers. We want to incentivize the customers to return those containers to us. So we make them essentially give us a deposit on those containers. If they return the containers, they will get that deposit back. But if they don't, then we get to keep, Rancor Chemical Company gets to keep the deposit. So the details of this given accounting period is that we had total revenue from the sale of the chemicals of $15 million. The cost of goods sold for those chemicals was $8 million. So we're going to account for the sale and the cost of sales as it relates to the chemicals that were sold. In addition to that, and we're going to assume that all sales were done in cash. In addition to that, we are going to assume that we collected $300,000 worth of deposits as it relates to those containers that the chemicals were transported in. So we not only charged our customers $15 million for the actual chemicals, we charged them an additional $300,000 for those returnable containers. If they return the containers, we'll give them their money back. So what we're going to assume in this instance is that 90% over the given accounting period, 90% of those containers were actually returned to us within the allotted time. And then we're going to have to account for, all right, what happens with the 10% that wasn't returned to us. So we're going to go through that set of details in our Excel spreadsheet. So if I go over to Excel, advanced collections is the general topic that we're looking at. And again, we have different types of unearned revenue that you can see accounted for in all of these different situations. But what we're going to focus on the left-hand side here is the refundable deposit example. So again, here's all the details of our transaction. The first entry that we want to record in our journal is just related to the sales that were made and the deposits that were received, as well as the cost of goods sold of those chemicals that we sold to the customers. So again, just to record the actual sale of those goods and the deposits that we received, we're going to debit cash, and cash is going to be debited for the $15 million plus the $300,000 that we received from those customers as it relates to those containers. We are going to credit sales revenue for $15 million, and then we're going to credit unearned deposits or refundable deposits. The name isn't super important as long as we understand that this is a liability that relates to deposits that customers have given us that we are going to have to pay back if they return that container, right? So unearned deposits, refundable deposits kind of mean the same thing in terms of the account name that we're using. And then the last part of this is going to be we need to debit cost of goods sold, and we need to credit inventory for the chemicals that we sold to that customer. So the cost of goods sold, $8 million. The credit to inventory, we're decreasing our inventory account by $8 million. Okay, so once we've accounted for all of the sales and the deposits that we received, now we can turn our attention to the fact that over the accounting period, we're going to assume that 90% of those containers were actually returned to us, and so we had to give those customers their deposit back. So the way that we're going to account for this is going to be to decrease the unearned deposits or refundable deposits account by 90% of the total. So we're going to take that total and we're going to multiply it by 0.9 in my Excel spreadsheet. So $270,000 worth of those deposits we are now removing from our accounting records because the customers gave us the containers back. And so what did we give them in exchange for giving us the containers back? We gave them cash. So $270,000 of cash. So again, notice we received cash related to those deposits and accounted for it here. And now we're paying cash, but this isn't an expense to our business. This is just a return of that cash to the customers because they gave us those containers back. So we account for the return of those containers. Now, lastly, let's say that there was a time limit, right? So that maybe by the end of the accounting period, the customers had to give those containers back to us. Otherwise, they forfeit their deposit. We now need to account for, number one, the deposit that was forfeited that now we can account for as earned revenue. We essentially can account for that as a sale of the container. They forfeited returning that container. Therefore, we essentially sold that container to them. So we're going to account for the sale of that container, and we're going to remove the unearned deposits, the remaining balance of $30,000. And we have to account for the fact that because this essentially is now turning into a sale of that container, we're going to have cost of goods sold implications as well. And if you remember, if I click on over to the PowerPoint, if you remember, the last piece of information that was given to us is that the deposits that are charged are twice the actual cost of the containers. So what we have remaining is $30,000 of unearned deposits or refundable deposits remaining $30,000, right? Because we received $30,000 worth, we received $300,000 worth of unearned deposits. We accounted for $270,000 worth that had been returned to us. Now we're accounting for the fact that $30,000 worth of these containers are now essentially being sold to those customers. They didn't return them in time, therefore now they keep them, and we account for that as a sale. So that's going to be accounted for as sales revenue related to the containers. So this isn't sales revenue as it relates to the chemicals. This is sales revenue as it relates to those containers. And then finally, as I said, if deposits charged, right, so we charged them $30,000, is actually twice the value of the container itself, then that means the containers that are included that were essentially given the deposits of $30,000 were only worth $15,000. We charge them twice the value of those containers. So now what we have to account for, because again, this has now morphed into a sale of containers. We're now sort of changing up the way that we're looking at this, and now instead of looking at it as unearned deposits or refundable deposits, now we're essentially looking at this as, well, you didn't return the container in time, therefore this is now accounted for as a sale of that container. So when we account for the sale of a product, we also have to account for the cost of sale of that product. So cost of goods sold and a credit to inventory. And again, if the deposits that we charged were twice the value of those containers, then the value of those containers, the cost of those containers, is $15,000. So again, this is an example where we have essentially unearned revenue until something happens where we either refund the cash to those customers, or we wait until the time limit is up, the customers don't return the containers, and we can then account for those containers or account for those deposits as a sale of the container itself. So again, as you work through the PowerPoint lecture, there are going to be a variety of different examples, and they will have a corresponding problem outlined in Excel. So kind of toggle back and forth through the PowerPoint lecture and each of those examples into the Excel spreadsheets and practice what the journal entries would be for each one of those transactions. So in chapter